the Fed is on this rate hiking path with reckless abandon to stop inflation. Now, inflation as they define it as prices going up. I like the Austrian viewpoint of inflation is when the monetary supply increases. But they want to stop prices going up. Now, prices are the equilibrium of supply and demand. So what they want to do is just crush demand. Well, let's just make everybody broke. Last week I played some video clips of Senator Kennedy grilling Jerome Powell and saying as much. You want, and actually I played a clip of Elizabeth Warren as well, saying you want unemployment to go up. You want 2 million people to lose their job. What do you want to say to those 2 million people, right? So they literally want you to go broke. They literally want people to lose their job. They want your wages to come down to get that down. Now, the other side of the equation is they could try to get prices to come down by bringing more supply to market. They could do all types of things like tax credits if you create more goods and services, right? They could do all types of things, relax regulations to get more supply to the market. They could do things like that, but they don't. And so they're trying to do this. However, as they're crushing demand, they're also crushing demand. And when people don't have as much money, they don't pay as much taxes. You and I have talked about this. So two things are happening here, and this is what's interesting to me. As they raise interest rates, the payments on the debt servicing goes up. That's their expenses. But their income is going down because they're getting less tax receipts, the U.S. government. Can they keep hiking? If they keep hiking, the government keeps going more broke. The banks continue to go more broke. Is this the end? I saw, looks like as of yesterday, the betting markets were saying that there's like a 90% chance of a pivot before the end of the year. What's your take on that?
Yeah, so there are a couple things. The first one is that the Fed usually remits its profits to the United States Treasury, right? The Fed is a bank, just like any other, right? And it holds these securities and it takes in cash flows from these securities. But it has been winding down its balance sheet, of course. And so now it's no longer getting cash flows from those treasuries that it's allowing to mature off its balance sheet. And as a result, now it has gone negatively profitable. It is no longer profitable and it doesn't have any profits to remit to the U.S. Treasury. And as a result, it's been creating on its balance sheet an accounting gimmick, what's called a deferred asset. Rather than the Fed, because it's hemorrhaging money, going under like any other bank, right? Like Silicon Valley Bank did. The Fed has the ability through this accounting gimmick and a magic wand to essentially just put it on its books as a deferred asset. Now, if it's deferred, when does it have to be repaid? Well, that's the cool thing. It never has to be repaid. If you read the fine print about what a deferred asset is, then the Fed can choose when it wants to actually repay that. And so it's racking up tens of billions, what will eventually be hundreds of billions and potentially even trillions of dollars worth of debt that the Treasury isn't getting. So the Treasury isn't getting those profits from the Fed. It's bank, right? The United States Bank. And at the same time, it's facing a massive maturity wall next year on debt that was issued at an average coupon of just 1.5%. If you look at
30% of the debt has to be refinanced in the next 12 months.
Yeah. And so 30% of the debt, you take a look at the fact that there's this massive maturity wall, right? 30% of the debt that has to be refinanced at a rate that is 3 times what it was financed at previously. But the Fed is also not remitting profits to the Treasury. So the Treasury is not getting any money to refinance this debt. It has this big maturity wall coming up and has to refinance it because rates have risen to 5% all across the curve at basically 3 times the price. And so that's the crisis that the Treasury is facing now. And with the debt ceiling approaching, obviously that's going to be raised, the question has to become how much longer can the Fed keep influencing these short-term rates higher when the Treasury is facing this big maturity wall. And the question would see, it's this unstoppable force that's meeting this immovable object. I don't necessarily have the answer for it, but certainly the answer seems to be more debt issuance, right? More people gobble up this debt so the Treasury can continue financing itself through this debt. And I tend to believe that the Fed is probably going to be a big buyer of that. And it's going to resume quantitative easing and purchase that debt in big quantities in order for the Treasury to finance itself. And so it's the snake eating the tail, and that's going to continue going on cycle after cycle.
Yeah, the Treasury, not only is their interest payments going up, so 30% of that debt has to be refinanced from the 1s up to the 3s, 4s, whatever the rate's going to be at that time, which is going to double, triple, quadruple the amount of interest payments they have to pay. But then their tax receipts are going down. So tax receipts are down 9%. So their receipts are dropping. So it's a real big problem that they're in. As far as the banks go, I mean, I was thinking like, well, shoot, they can't keep raising rates. The banks are all going to go bust. But now with this new facility, Joseph Wang, the Fed guy, I've had him on my show as well. Great interview. Go back and check it out on my main YouTube channel. Just search Mark Moss, Joseph Wang. But he's saying that now that basically this facility has been put in place, the Fed can continue with their hiking.
Yeah, essentially that's what it's done. So I'll give an analogy to the listeners. Perhaps you might remember, I don't know if we discussed it when I was last on the show, but last year there was a scare in the United Kingdom sovereign bond market. Essentially, it played out largely similar to what happened here in that the value of those United Kingdom bonds dropped so much that people that were holding them on their balance sheet and actually leveraging them were facing margin call. And what needed to happen was the Bank of England stepped in and said, we're going to buy as many of these bonds as is needed is to stabilize these funds and make sure that they don't default. So essentially, that allowed the Bank of England to intervene and stabilize its bond market and its financial institutions while continuing to tighten policy. It's raised its policy interest rate by several percentage points since then. And that's the same thing that you're probably going to see with the Fed here. The Fed, via working with the Treasury and the FDIC, has created this facility just to stabilize banks, but it hasn't indicated, and I don't think it will indicate, that it plans to stop keeping policy rates elevated. Whether it's going to pause relatively soon and hold it there or keep hiking in 25 basis point increments, basically this new facility allows the Fed to stabilize the banking sector, basically saying if you ever run into liquidity issues, don't worry, you can borrow from us and we won't tell anybody, so that way there's no stigma related to you as a bank. All the while they can continue hiking. And it's a way of the Fed that the Fed can play this monetary magic, have their cake and eat it too. But at the end of the day, it's just introducing new risks and dispersing those risks through the financial system. So eventually, when we have to pay the piper, when the Grim Reaper is finally at our doorstep, the crisis that we have to contend with will be all the more worse.
So the Fed has basically backstopped the banks by giving them par on all their treasuries. So forget that you've mismanaged it. Forget that you haven't paid attention. Forget that you haven't hedged anything. We're just going to make you whole. So that brings the banks whole. And now they've effectively backstopped all the depositors. So we had up to $250,000 FDIC insurance on our bank deposits. And the Fed has said, well, we're just going to bail out all the depositors as well. So basically the Fed is backstopping both the banks or the Treasury market, and they're backstopping the depositors as well. That's where we're at.
Precisely. That's exactly what they're doing. And frankly, if you look at the size of Silicon Valley Bank as an institution, the Fed created, in order to justify bailing them out and, obviously insuring all uninsured depositors, they created what was called a systemic risk exception. This was a phrase that was thrown around much more in 2008 when 200, 300, 400 banks failed and the FDIC had to take those over the next decade. But this bank, Silicon Valley Bank, was the 18th largest bank in the United States. It only had $212 billion worth of assets. All told, right, compared to the big four, JP Morgan, Citigroup, Wells Fargo, and JP Morgan Chase, it was a pretty small bank. And so what does that tell us about the solvency concerns of the banking system at large? If this $212 billion bank was systemically threatening if it went under, so the Fed decided to bail it out, what does that tell us about the larger institutions, right? Are the larger institutions just as fragile, right?
And then they're saying, well, if Peter Thiel didn't put out that tweet about pulling money out, it wouldn't have collapsed. And it's like, if people wanting to get their money out of the bank causes the banking collapse, maybe the banks were already ready to collapse.